Hey everyone, welcome back. Today we're diving into a trading indicator that's really built for speed. The Connors RSI, or as you'll see it, CRSI. Especially if you're a short-term trader, this one's for you. So let's get right into it. So let's kick things off with a question I'm sure a lot of you have thought about. The Standard Relative Strength Index, the RSI. It's a fantastic tool, absolutely. But for those of you who are in and out of the market fast, the scalpers, the day traders, that default 14-period setting can feel like you're always one step behind the action, right? Well, that's the exact problem Larry Connors wanted to solve. And his creation, the Connors RSI, isn't just some slightly tweaked version of the original. Oh no, it's a full-on composite indicator. Think of it like a hybrid engine that blends three completely different ways of looking at momentum into one single super fast signal. Okay, so how does this 3-in-1 indicator, this high-performance engine, actually get its speed? Well, the secret is that it's not really one indicator at all. It's an average of three, and each one is looking at the market from a totally different angle. So these are the three pillars of the CRSI. First, you've got your raw, short-term momentum. Simple enough. Second, it measures how long the current trend has been going. And third, it looks at just how big today's price move really was. Let's break each one down. All right, component number one is probably going to look familiar to you. It's basically the standard RSI, but with the dial cranked way down from the usual 14 periods to just 3. This makes it incredibly sensitive and reactive to what's happening in the market right now. This is the core momentum reading. Okay, now this is where things get really creative. The second component, it doesn't even look at price. It looks at time. It literally just counts how many days in a row the price is closed up or down. That's the streak. And then it runs an RSI calculation on that streak count. So it's measuring the momentum of the trend's duration. Pretty cool, right? And the final piece of this puzzle puts today's move into context. It takes the price change from the most recent day and ranks it against all the price changes from the last 100 days. It's basically asking a simple question. Hey, was today's move a big deal, or was it just business as usual compared to the last few months? So you've got these three totally different numbers. How do they become one indicator? Well, the answer is surprisingly simple. It's just a straight average. You take the value from that 3-period RSI, the value from the RSI of the streak, and the rank of the price change. You add them up, divide by 3, and boom! You get one single number between 0 and 100 that packs in all that information. Okay, so we know how it's built. But how do you actually trade with this thing? Well, just like the regular RSI, it's all about spotting those overbought and oversold conditions. But there's a really critical difference here. And believe me, this difference is huge. Because the CRSI is so twitchy and volatile, those standard 70-30 levels you're used to, they're basically useless. You can just throw them out the window. Instead, you have to look for much more extreme levels. We're talking over 90 for overbought and under 10 for oversold. Some traders even push that out to 95 and 5. So these extreme readings get used in a couple of main ways. If you're in a nice uptrend, a quick dip below 10 could be a fantastic chance to buy a pullback. On the flip side, if the market's just chopping sideways, a spike above 90 could be your signal to sell that rally. But notice the big theme here. You almost never use this thing on its own. It absolutely needs confirmation from other tools, like a long-term moving average. No, a faster, more complex indicator? It sounds amazing in theory, doesn't it? But what actually happens when we put it to the test? Let's take a hard look at the limitations of the CRSI, because as you'll see, more complexity doesn't always mean better results. On the surface, the numbers can look incredible. I mean, check this out. A backtest from Quantified Strategies on a really simple CSRI setup found a win rate of 75%. That's 3 winning trades for every 1 loser. I mean, who wouldn't sign up for that? But, and this is a huge but for every trader to remember, a high win rate doesn't tell you the whole story, not even close. Because if those few losing trades you have are absolute monsters, they can completely wipe out all the profits you made from your dozens of little winners. And this is the real kicker from their research. When they tested the exact same strategy, but swapped out the complex CRSI for a dead simple 2-day standard RSI, the results were actually better. The fancy, complicated indicator got beaten by the simple one. That really just goes to show that sophistication doesn't automatically give you an edge. So let's put it on together. What are the big red flags here? Well, CRSI is known for jumping the gun and giving signals way too early, especially if you're fighting a strong trend. It spits out a lot of false signals, which is why confirmation isn't just a suggestion, it's pretty much a requirement. And finally, those 90-10 levels, they're not a one-size-fits-all solution. You often have to tweak them for whatever you're trading. So where does all this leave us? It means we need to think of the Connors RSI not as some kind of magic bullet that solves everything, but as a very specialized tool. It's like a scalpel, designed for one very specific job. And here is that job description, plain and simple. The CRSI is a sharp, highly responsive oscillator that is built for pure speed. It's for scalpers and very short-term traders who need to pinpoint those quick pullback opportunities inside a bigger trend, and most importantly, who understand and respect its limitations. And really, this all brings us to a fundamental question that every single trader has to answer for themselves. The CRSI proves that a more complex tool isn't always a better one. So I'll leave you with this. When you think about your own strategy, what's going to win in the end? Does the fancy nuance of a complex indicator give you the edge? Or does the clean, robust power of simplicity serve you better? The answer to that really defines who you are as a trader.